Fark Talks. My name is Hannah Kim. I'm the Global Initiatives Lead at Fark Labs. And we're excited to be hosting Zeynep Young tonight, both as Fark Labs and as ARIA Women Investment Platform. So, before I welcome Zeynep to the stage, I'd like to welcome our Chief Entrepreneurial Officer and the founder of Fark Labs, Ahu Serter.
Wow, that's my applause. Thank you very much. Everybody welcome. So we are not used to this many crowds. We're used to more of 200s and stuff here, but this feels very cozy, so it's good to see everybody live again. I met Tuba for the first time today, one of the co-founders of Optio. We invested in her business, and in 2 years, it's the first time we met. So it's great to see you here, and all of you that I know from before, and all of you we're seeing today for the first time. Some of the questions that were asked to me when I was welcoming the people here led me to put some slides on Fark Labs so that you know what we are doing here, and then I'll introduce you to Zeynep. So why, as the CEO, Chief Entrepreneurial Officer of Fark Labs, why did I feel the need to found such a lab? I read this book called Dual Transformation, how you take a legacy business and make it new again, and how you are freely look into the future and prepare for it. We are all trying to do that in our own companies, but then I felt very limited to the extent that we could do it. So from that need came the need to bear a place like Fark Labs. So this is our industry vertical. This is our legacy business. We are in the automotive and the white goods and different things. Then we said, where will the automotive sector evolve in the future? And we started looking for the answers to this one. And then we found the first vertical, mobility. And in the mobility side, we do a lot of things. We do ideation, we do venture building, we do venture investing. We also invest in other venture funds in the world. We have offices in Korea, Paris, soon to be in Shanghai and Michigan. We have one in Ankara. We were going to open one in Bodrum, but everybody went to Bodrum, so it's time to get out of there, so we decided not to go. Izmir could be one, yes, in the life sciences vertical especially. Then during the pandemic, we started in an agile way of producing life sciences products, because a lot of the things were required to be produced in very, very fast. So our engineers worked with the health professionals, and then it was a good proof to our board that you can be in the life science. You don't have to go into clinical trials in order to be there. So we started investing also in health companies, and then we have the sustainable lifestyle division. ARIA is one of our star initiatives, of course. It's a social venture, as you know. We are investing in female-led businesses, and we are educating females to become investors, and we also take men. And we don't charge them, it's free of charge for men, and we have very good men. Some of the ARIA men are with us today, so welcome. And then we have the Curiosity Cabinet. These are all the technologies that we are curious about, but not yet have the knowledge to make vertical. So we are in that, we are cooperating with partners who have the knowledge, but who doesn't have this footprint. So they come, for example, with SoftBank. We're going to start an AI vertical very soon to look for startups that are operating in the AI space. Overall, we approach innovation like an investment portfolio. So when you see these are all the things we do in Turkey, and these are all the companies we do in the meantime, and then through all offices, we do not repeat the same activity, but we find the best partners to cooperate with us in those new spaces. So it's like kind of an investing approach, let's say. I think it's coming from my background, but this is how we would like to approach innovation so we don't miss anything in our vertical. So, and we all work for a better future together, and anybody who would like to work for this purpose is welcome to be with us in Fark Labs. So, having said that, I'd like to introduce you to a dear friend of mine. We met in 2014 in a conference in Austin, Texas, and then we always stayed in touch. Zeynep had a very interesting journey, she will tell you herself, but it was great to have a Turkish American be with us, also be interested in Turkish companies, knowing she was very patient today. I think you listened to how many companies? 10? 15? Yeah. So thank you for that, Zeynep. The feedback was great. And with that, I introduce Zeynep Young to you. Welcome.
Thank you, so much. Do you want to sit with me, or you want Alan's going to sit? And I don't think I need this. I'm super loud. Okay. Can you guys hear me okay? That's not so loud. Okay. So I'm going to share. Oh, thanks. Is this really loud, or is it just me? It's a little loud, right? Okay. Is this better? I'm going to talk softly. Okay. So let me introduce myself, and then I'm going to share a couple of trends about the U.S. funding market. But then I wanted to keep my remarks short because what I'm really interested in hearing from you guys and hearing your questions and be able to interact in dialogue. Because, you know, many of you may not be raising funding right now in the U.S. market, and so I don't want to, you know, provide a lot of content that's not of use to where the entrepreneurs are today, but I would love to share any of the lessons learned from my side as both having been a founder and CEO, as well as having been a funder. So just a little bit about my background. I'm going to start early because I was born in Izmir, so I'm Izmirli. And then my parents moved to Houston, Texas when I was 10 years old. And so then I grew up in the US since then. But then have always, of course, loved Turkey. And my parents moved back about 20 years ago, back to Izmir. So we come every year as a family for vacation. But this is actually the first business trip that I've had to Turkey. And so it's really inspiring for me. And I want to really thank Ahu for hosting me. And she served as such an inspiration to me for the last 10 years when we first met at Dell and in Austin. But I have to tell you, every time I catch up with her, and then of course I see her life on Facebook, I'm like, I don't know what I'm doing with my life, and I don't know why I only have one job. Like, how can one woman have, you know, 200 jobs, and I like have one job? So both source of inspiration and a little bit of envy, but very much admiration. But thank you for hosting me. So I grew up in Izmir, but have then worked all my life in the U.S. market. But I'm really motivated to make this first trip to Istanbul for business purposes. I started off my career after business school at McKinsey. And so I started at the McKinsey Houston office and then continued on with McKinsey for 8 years. And I worked in their Texas office. I spent 2 years in Munich. And then I spent a couple of years on the West Coast. And my focus areas have been mostly on software and semiconductor, and then primarily around revenue growth, and in particular, sales optimization. So my expertise is really on the go-to-market side of a company, and really thinking about when something has good product market fit already, how to really take that from, let's say, $500,000 in sales to 10, 20 million in sales. So I spent about 8 years at McKinsey, and then I left to go work for Michael Dell in Austin. And at that time, Michael Dell and his family office were doing a lot of ESG investments. So interesting investments into education technologies, interesting investments into healthcare that were both intended to be financially good deals and good investments, but more importantly, have a positive impact from a social impact perspective. So really took what I learned from McKinsey in terms of technology disruption, but coupled it with my interest in having social impact alongside of that. So I spent 4 years investing in a fund that was $150 million of investments. And then after 4 years, I decided to leave and start my own company because one of the things that we were seeing on the education side for U.S., let's say middle school and high schools, we were looking for data platforms that allowed educators to better understand student needs and to improve student performance. And I was searching for these companies, but really not finding anything that I thought was really compelling. And so when I started to think about the problem and what our choices were in terms of investments, I thought, I bet I could do this, faster, better, cheaper than what people are doing today. And I think a lot of entrepreneurs start that way. When you're experiencing an obvious need and you think, I can't believe nobody else is trying to solve this problem. I see such a market opportunity. So I left the Dell Foundation and I started my own company called Double Line. And we were a data and analytics platform in K-12 education. And we grew, I bootstrapped the company, which is that I didn't take any investment, either seed or institutional, and used our own money and then of course customers to fund the growth of the company, and went from 0 to 20 million in revenues within 5 years. So then sold that company in 2016 and was really thinking about what I wanted to do next. And one of the things I was really energized about was then working with other entrepreneurs to help on their journeys, to fund their interesting ideas. So I joined a venture capital firm in Austin that was really at that time looking at funding what we're now calling the rise of the rest. So even as sort of, late as 2016, we were seeing VC investment very much focused in California, and then focused somewhat in New York and Boston, but very little investment into geographies like Austin. I mean, Austin right now I think is one of the most exciting tech centers in the US, but really about even 6 or 7 years ago, we were really struggling to be recognized as a legitimate place where startups could be, right? And so it was really interesting to work in that VC because we were really primarily targeting Austin, but then other cities that we thought had great tech potential, like Salt Lake, like Denver, potentially Detroit, really thinking of places that had technical talent and entrepreneurship drive, but that had been ignored by other VCs, by traditional California-based VCs for a long time. So did that for 2 years and actually really enjoyed that role. We also put a heavy emphasis on female founders and female entrepreneurs because we really felt like that was also an untapped market for talent that had been long ignored. So that was a passion area of mine and really enjoyed doing that. I think, at the time that I was there, only 4% of VC funding went to female founders. And the 2 years that I was there at Next Coast Ventures, 26% of our funding was going to female founders and diverse management teams. So really developed a passion for finding untapped markets and untapped potential. After that, I got lured back into being CEO. I think I've always had this, funder and then CEO sort of back and forth. I think being a funder is incredibly exciting because you get to hear these fabulous ideas and meet these exciting entrepreneurs and really brainstorm with them and hopefully help them on their journey. But at the same time, I say it's a little bit like being a travel agent. But it's every day you're meeting with people that are going to go on these incredible journeys, and then they leave, and you're like, well, good luck, call me if you need anything, and then tell me about all your amazing experiences, but you're very much stuck in the office and not out in the market. And so I jumped back into being CEO and took over a software company in March, right when the pandemic hit. So I accepted the offer, and the next day, the entire company went into lockdown. So I was brought in to actually improve the financials of the company and then to sell the company to a strategic. So that took 9 months. This was in 2020. And we sold the largest software deal in the whole history of the company at $2 million of ARR, opened up a new geography in Australia and New Zealand, and doubled profitability in the company within 9 months during COVID. And we ended up selling the company in November 2022. And I never ever met any employee physically during that entire time. So I'm sure many of you that are doing your startups now have had similar experiences. In fact, you guys just talked about the fact that you just met for the first time in, I mean, maybe 2 years. So that was a really unusual experience, but a really terrific one and a very good outcome for both the company as well as the investors. And then after that sale, I actually joined the private equity company that was the investor in this software company called Calitera as a strategic advisor. So now what I do on the private equity side is, of course, I meet with entrepreneurs like you and think about growth funding. I also work a lot with our portfolio CEOs to really share some of the lessons that I've learned as a CEO and some of the lessons I've learned at McKinsey, particularly around driving revenue growth. And then lastly, I'm co-CEO of our SPAC. We have a SPAC effort that we're searching for a target right now. And so part of the reason I came to Turkey is I think this theme is starting to now happen of the rise of the rest for geographies like Turkey. There's incredible untapped potential in these markets like Turkey, where the schools, there's deep engineering and technical talent, and there's a great market, and there is, historically, Turkey has been, I think, very entrepreneurial, even before the tech entrepreneurship became very fashionable. I think 80% of the businesses in Turkey are SMBs that are started up by this generation or just the prior generation. So there's that great deal of entrepreneurship, and there are a lot of companies here that are having great traction. And again, it's great to see, female leadership, like Ahu and what she's doing with Arya. So all those compelling reasons brought me here, thinking one about SPAC, but also really just thinking more broadly about funding and thinking about extending funding internationally for us. So really thrilled to be here. Thank you for hosting me. And I'm gonna talk a little bit about lessons learned as a founder and a funder. And in particular, I want to highlight some of the themes that are happening in the US funding space. But again, I'm going to keep my remarks short, and then I would love to entertain questions because I'm here to meet you guys and hopefully share some of my experience that would be helpful to you. So it would be much more helpful if we could have a dialogue. So with that, let me just launch into this. This is not, the first trend that I'm going to highlight to you guys is not going to be, a surprise to anybody, but crazy money is flooding the market. There has been so much incredible fundraising. I mean, just to really look at what 2021 looks like, and again, when we compare it to just sort of 5 short years ago, I think that, the market has almost doubled in terms of funding that's searching for some targets. And that's an incredible trend because every year we think this is the maximum. Like there just can't be more money coming into the market, and yet we're just seeing more and more appetite out there. At the same time, if you look at this, the number of funds has actually decreased, particularly sort of around this COVID. So some funds have actually decided to close up shop, and I think that's what's happening is the rise of these very large funds. So lots of money, lots of funds that are big, and they're searching for targets. And it's making for a very competitive funding environment in the US. And when I say competitive, I mean for funders. So, where the dynamics used to be several years ago that, founders were having to go VC by VC, sort of begging for money and spending a year trying to raise capital. Now it feels like the pressure is on funders to sell ourselves to really promising entrepreneurs. And that is a real dynamic shift that's really happened in the market over the last maybe 12 to 18 months. Money flooding to winners. So the other thing I wanted to highlight is the rise of these mega deals, which has been quite interesting. So what's happening is investors care about growth at all costs, and growth and backing sort of early market winners. And so what we're seeing is sort of early winners that have traction, raising rounds that are like $100 million. Right? And the rise of those, what we're calling mega deals, is a really interesting phenomenon because in one sense, it's really giving a lot of fuel for growth to the early winners to be able to dominate a market space. But in a negative way for other founders, it's sort of shortening the competitive time that you've got to establish yourself as a market winner. Because once somebody in your sector gets a $100 million round, I mean, other investors look at that as sort of game over, right? Only one or two players in a specific sector can win one of these mega rounds, and then it sort of kills it for a lot of other folks that are competing in the same ecosystem. So as you think about, you know, what we're counseling our entrepreneurs to think about is how you make sure that you take advantage of some of these trends and avoid being sort of sidelined if there is one of these mega deals in your sector. Let's see. So thematically, also, one of the things that we've noticed in the US market is fintech is white hot right now. Everything is fintech. I mean, I could be, you know, selling water on the street and I'm gonna call it a fintech company. The idea of coupling software with either marketplace revenues or payments revenues is extremely popular for all verticals right now. And so this is something that we see a lot of traction in, and I don't think that's going to stop anytime soon because there are a lot of verticals where there are credible software plays, but their payments and e-commerce solutions have been largely sort of dominated by legacy players. And we're seeing that shift very, very quickly. So I'll give you an example. One of the startups that I'm involved with is called Televet, and it's for the veterinary market. And they started off as workflow software, and what that means is, in terms of checking, you know, patients in and out, billing them, recording what the disease is for the dog or the cat, all of these kinds of work that the office staff is doing to support the vet is the workflow, right? And the company actually had a software product that really made that easy and automated many of those tasks. So that was the first product. And they were actually charging, you know, software SaaS revenues for that and recognizing ARR. And then what they decided to do was add 2 modules on top of this product. This is a very small company. This is about, exiting this year, they will be about $3 million of trailing 12 months ARR. So we're talking very small companies still by the US market. But they decided to add a payments engine to their workflow software. So they were asking the vets to start checking out all of their customers, right? The cost of the visit, plus anything that was being bought, like medicine for the dog or food, to be charged through our payment system. Well, and then they also added an e-marketplace component specifically for vets to capture the pharmaceutical sales, right? So when your doctor or your vet writes you a prescription, you can take that prescription and just go buy it somewhere else. And of course, the vet is losing an opportunity to make a sale there. And they're becoming kind of irrelevant in their relationship with their clients. Because there's the rise of Amazon and Chewy, where they're direct consumer models that are disrupting that relationship with the vet. So they added an e-commerce platform. So when you think about how those 3 different modules are valued, the ARR, which is the majority of the company's revenues and actual real money, is almost valued at this point from a valuation perspective as 0. Like, who cares about ARR, right? And people are honing in on the volume of payments that you can capture and the e-commerce volume that you can capture, because those modules make money for the company without charging the customer anything, right? Because the costs are borne by the users that are used to paying for a credit card charge, or they're used to paying something as a percentage from that sale. And so we can practically give that software away to just create a frictionless sales experience to get it into as many veterinary offices as possible, because we then make so much money on the payments and e-commerce modules. So I talk about this in terms of what's really hot right now. Fintech is really hot right now, but it's not necessarily deep fintech, right? We're not writing like trading software for banks or risk management solutions for insurance companies. We're talking about payments and e-commerce kind of taking on a different spin. And I think this is a very interesting trend right now in the US market, and everybody is sort of pivoting their companies to be able to capture this. What's losing ground, I think, is consumer, the direct to consumer types of businesses. I think people are starting to see one, how expensive it is to capture consumers from a marketing and advertising perspective, and how fickle customers can be just in terms of, keeping that customer, unless you're Amazon. And of course, you're seeing competition from giants like Amazon in the consumer space. So we're seeing a little bit of a cooling off, again, from a funding perspective on consumer concepts. And then again, very much interest in fintech, funding fintech, and a lot of interest from startups to pivot to encompass fintech in their solutions. Non-traditional funders coming on so strong. Part of what's fueling the rise in the dollars, that are under management for funding purposes is that non-traditional funders are really entering the space quite strongly. So when I think about non-traditional founders, I'm thinking, organizations that were not traditionally venture capital or private equity. So some examples of that are banks, like strategic corporates are entering into funding. We're seeing interesting plays just around like universities trying to spin out their research arms, but coupling that with venture funding to be able to get early investments into deep tech kinds of concepts that they truly understand very well because they have the researchers and sort of the thought leaders in those spaces. We're seeing just wealthy individuals set up differently structured funds that are not traditional VCs and private equity concepts to enter this marketplace. So the marketplace and the competitive landscape is changing a lot. I can talk a lot about, I think, the pros and cons of this and what taking money from a non-traditional funding source looks like versus an institutional investor. So happy to touch on that if that's of interest to folks. Valuations, this is not news to anybody, are absolutely sky high. A lot of these trends that I just talked about are fueling these valuations, right? The fact that people are getting mega rounds, and so you have to have a very high valuation. The fact that there's early winners decided in this space that drives valuations. And also, the total money under management is sort of driving this trend of being able to write checks that people weren't able to write before. And I will say the rise of, I think, non-traditional funders are fueling this. There is a lot of money that's entering the market that's not as familiar, and they're not household names. And in order to win deals, they're using valuation as a lever to win deals, right? If they're talking to an entrepreneur and an entrepreneur is getting a valuation of 20 million, pre-money, these guys are coming in and saying, we'll give you 30 million pre-money, 40 million pre-money. You've never heard of us, but that doesn't matter. Our money is just as good as anybody else's money, and we're going to give you a higher valuation, and we're going to take less of your company. And so we're seeing a lot of competition from this, and it's really raising valuations higher and higher. I think, again, we can debate whether that's a good trend. In some aspects, I think that's very favorable to founders because the money is cheaper. You don't have to give away as much of your company to get the capital. In other ways, I think it's quite sort of a false promise. It's difficult to manage funders that don't actually know what they're doing, especially if they're on your board, because people have very unrealistic expectations about how you can grow, what meaningful traction looks like, what are smart ways to expand business, and what good exit options look like. And so it's difficult to manage those kinds of expectations if you've got people on your board and on your cap table that are not very familiar with the ecosystem. In addition, I think this makes exits difficult. So we are seeing a lot of folks that had gone out and gotten very high valuations on, let's say, a Series A or a Series B, and when inevitably you don't grow as fast into that funding, all of a sudden I think you're either looking at a down round, right, where you're picking up money at a valuation that was lower than your last round, or you're becoming an easy target for somebody else to pick you up cheaply because you're not able to raise money at a higher valuation. So this, I think, is a sword that cuts both ways, although I think right now founders are very excited about getting the maximum valuation. When we talk with founders, and when I personally counsel founders, that's just one variable of the equation. I really think that getting a very smart funder on your cap table, specifically people who know your industry, your vertical, and your ecosystem, I think is worth, much more in terms of adding value to the company than an initially high valuation out the gate. And then this is the other thing, and one of the reasons why we have a SPAC. So what we're seeing is two trends. One, companies are staying private longer and longer because there is so much capital in the market that you really don't have to exit to a strategic. I mean, you can fuel your growth with additional, Series C, Series D, Series E for a really long time. And then the valuations are really high. And so when it gets time to exit, there are not very many buyers out there for a company that requires a $5 billion exit to make money for its early investors, right? And we're seeing a lot of investors put structure into their term sheet and preference in terms of distributions and exit options. So it makes it very difficult to exit, at less than what you were valued at your last round, or more like at least 3x what you were valued on your last round. And so we're seeing a lot of these startups then have to explore either a traditional IPO or a SPAC as an exit, rather than to really becoming profitable and or being bought out by a strategic because the valuations are so high. So these are some of the interesting, I think, trends that I wanted to share and highlight about the US market and what's happening in the funding ecosystem. But I'd love to just stop there and then, just entertain any questions, or happy to address or share some of my experiences, both on the funding side as well as on the founder side, whatever is helpful to the group.
Can you hear me?
Yes.
While we wait for, hello. I just wanted to say, for those who are on YouTube, I hope you can hear me, that we are entertaining your questions too, so please write them for us.
Zeynep, thank you. It was great. I hope we had 50% of the problems that you're having in the US here in Turkey. We would be doing really, really well, I guess.
I hear you.
We have other problems. But it's good to hear, because it gives also hope to Turkish entrepreneurs. For those of us who may not know what SPAC is, can you explain?
Yes.
And two, you said we have one SPAC that we are looking targets for. So how does this really work? Like, you get to do one SPAC and then you look for a target, or you have like 10, or you're looking for other things? How do you build a SPAC?
Yeah, let me tell you this. Let me tell you what a SPAC is for those of you that don't know. So SPAC is a way of going public, of IPOing, on either the New York Stock Exchange or NASDAQ. And actually SPACs have been around for a really long time, but the reason they seem very, very new in the last 2 years is, I think about 3 years ago, the SEC changed the rules around SPACs. And before those two rule changes, SPACs were considered a vehicle that was a little bit, let's say, shady in terms of being able to go public. Like, nobody took you seriously as a company if you were trying to use a SPAC vehicle to go public. I mean, 95% of public companies that went public went a traditional IPO route, where you would hire an investment banker and you would put together all your presentations, and you would take the next 12 to 18 months making your rounds with institutional investors, building a story about your company, and then being able to actually debut on the stock exchange. And then again, 3 years ago, the SEC changed the rules around the SPAC vehicle, and it made it much more attractive and a much more legitimate vehicle for people to go public. And at the same time as this trend that I just mentioned, there were companies that had stayed private for a long time, and they had really significant valuations, and they were looking for ways to engineer financial exits that were not either, an acquisition by a strategic or becoming a profitable company. And so we saw a huge boom in SPACs. Like, people just went and raised a lot of money. And what it is a SPAC is a special purpose acquisition company. So a group of investors will get together and raise money. In our case, we raised $200 million. And what we then do with that $200 million is we become a public company. Our company, called Build Group Acquisition Corp, is actually listed on the New York Stock Exchange. So we are a public company, but a shell public company in that we don't have operations, right? We don't have a product, we don't sell a product, we don't really have a management team, we don't really do anything except we look for an acquisition target. When we find that acquisition target and we make a deal with them, we effectively purchase that company, and in that purchase, in that transaction, they become a public company. So the benefits to this are speed and certainty, okay? So, and they're linked. In a traditional IPO process, what you have to do is decide today that in 12 to 18 months, you're gonna go public. You spend a lot of money, you spend a lot of effort, but in 12 to 18 months, the market might actually be quite bad. Or new competition might have emerged that has really lowered your, sort of prospect or valuation. So there's a lot of uncertainty about what's going to be happening exactly when you go public. With a SPAC, that process is really shortened to about 3 months or so. So you have greater visibility into being able to hit the right mark. And then the other advantage is that as you make your roadshow and you talk to institutional investors, one of the things that the SEC allows companies to do is to talk about forward projections and their plans for the future and why they think that they are an incredible investment. That's not allowed in a traditional IPO process. So there's an interesting way to be able to tell your story to the market if you're going to use a SPAC to go public. So for those reasons, I think it's become an attractive vehicle. Now what has happened is that there's some downsides to it. One is that in specific cases, it can be a little bit expensive, right? So a little dilutive to choose this vehicle. And the other thing that's happened is that now there's like 350 SPACs looking for a target. So that's made our life a little bit difficult. Again, maybe nice problems to have, but not for funders, is that lots of quality companies have been already taken by these vehicles, and some quality companies are sitting back and saying, maybe I won't do a SPAC because things look a little uncertain. There's a lot of, glut of SPACs crowding the market. I'm just going to wait and see. And so I think, it's a little bit of a turbulent market right now. And one of the things we wanted to do was initially we were looking at US-based companies, and we were seeing some good potential companies, but we were seeing a couple of trends. Again, some of them that I mentioned here, the valuations are really, really sky high in the US. And one of the unfortunate things that's happening is you might be able to convince one funder, right, that maybe is not very sophisticated or maybe is wanting to buy into the deal that you're worth $200 million, in valuation. But then you've got to convince institutional public market investors that you're actually worth that. And they tend to be much, much, much more skeptical than the one funder that wrote the giant check. And so we're seeing a little bit of a market correction when those companies debut at such sky-high valuations. And so one of the things that's making us sort of pull back from the US market a little bit is when we do take something to public market, we want to be really able to stand behind it and say, this is an amazing company, it's an amazing deal, it's going to do really well. And sometimes it's hard to say that. And so we wanted to broaden our scope and really look at international companies that have a lot of potential, that have traction in the US already or in foreign markets already, that can be really, that can really see some acceleration in their sales, in their brand recognition, in their sales efforts, in their adoption in the US markets through this SPAC process. And so I think that's a really interesting thing that we're really playing around with, is to see if that's a hypothesis that actually bears fruit. But I think, the SPAC is, for me, I think it's a very smart vehicle for specific companies because it really gives you speed and certainty to market. And I think it gives you an investor base that you know already, that if you have a good working relationship with, they'll be on your cap table and they'll be long-term holders as stockholders on your cap table. And so for those reasons, we're actually very bullish on the SPACs. But I think right now the US market is just a little bit turbulent, and so we want to make sure that we're looking at globally for that company that's going to have a really good debut.
Zeynep, thank you for your presentation. And if possible, I would like to learn more about the non-traditional founders and the university's research centers.
Yeah.
Thank you.
Sure. So we're seeing some really interesting activities there. I think, what came first was, I think, research departments sort of banding together and either spinning out concepts from the research to commercialization. Then we saw funds that were specifically targeting schools, like there's one that targets Harvard, one that targets MIT, where they have early seed funds for students coming out of those programs and to be able to capture, right, and invest in those companies. And then we've seen more collaborations and like co-working spaces, not co-working as in like real estate, but real co-working and interaction with the professors and the faculty on the university side, as well as the entrepreneurs, where they can come together and receive some advantage funding from the university. And then I think now we're also seeing something that's really interesting, which is alumni associations that are reaching out to their alumni base to say, like, let's say I went to Kellogg, and Northwestern has put together a fund, I think it's called Purple Arch, but they're reaching out to their alumni to say, if you're a qualified investor, maybe what you want to do is invest in this fund, right? And then that in turn is investing in either alumni at that school or more broadly as a mandate. And then we're seeing funds of funds, right? Taking all of those university associations and sort of creating these super funds. So there's been quite an evolution in terms of how universities and research centers are participating in the US funding landscape. And I think, and they all have their pros and cons, but we're seeing that get more and more sophisticated.
Any other questions?
Thank you for your presentation, Zeynep, and your story was truly inspiring for us. So I have a question about your founder and CEO story. So you mentioned that you were CEO of a software company and that you opened up sales in Australia, and it was one of the biggest sales. So as a co-founder of Optiol, a software company again, and you're trying to globalize to try to find different markets. So do you have any hints like going to other markets? How can we start? Maybe your experience go-to-market strategies, can you share with us?
Yes, so I think for me, the biggest success factor in terms of sales is understanding the customer need and creating a value proposition that really fits that, right? And I think it's sort of, sales 101, but where I see early founders and small startups falter is they're trying to pitch their perspective, like, why do I think this is exciting, not why does this solve your need, right? And so making sure that you step out of why you think this opportunity is compelling into why your customer wants to buy your solution, I think is a very different lens. And so this is one of the biggest, I think, mistakes that founders make when they think about sales. And so I would really want to make sure, as you think about not just new geographies, but really any sales, to challenge yourself about whether you're really thinking about how you're solving the customer's problem and how the value proposition really addresses that. I think that's one. But the second thing is, in terms of new geographies, I think it's really critical to have local expertise. So the way that we won that contract was to partner with a channel partner that already had very strong roots in that geography, and then they were able to walk us through that process and then help us win that huge sale. I think it's quite difficult, especially, if you're really looking at enterprise or SMB sale, to really open up that market without any expertise in having operated in go-to-market models of that market. So I would definitely think about those two things as you open up new geographies.
I have a question actually, Zeynep. It was something we were talking about earlier today about when to go abroad. And you had made a very specific distinction between getting traction in your local region and then trying to use that to go abroad versus going abroad immediately to the US. Could you talk a little bit about that for our founders?
Yes, absolutely. I mean, so my preference, of course, being a US-based funder, is that really as soon as you have a business, your startup, be thinking first about global markets. I mean, US is an obvious one, but there are other large global markets out there, because I think the way that you develop your product, the way that you develop your value proposition, if it's highly specific to your local geography, it just makes it a little bit more difficult than open up new geographies if the product or the service is hyper-localized to your current geography. The other reason I say, especially for companies in Turkey, to really think global markets first, is that Turkey's in a really interesting place, because Turkey has, deep, I think, technical engineering skills. There's a ton of talent here. And then from a thought leadership perspective and a technical perspective. And then the labor pools are also cheaper here than in many other parts of the world. So that makes for a very interesting place to actually start global businesses. But at the same time, the market is big enough where you really could, in most cases, be Turkey focused and still be a viable, vibrant, exciting startup. And that has a pro and a con. I mean, the pro is that you can start your startup here and have a geography that you're familiar with, have contacts that you already know, open up customer conversations where you actually have, relevancy in the market. I think the downside of that is when you then try to expand into, let's say, a market like the US and you show your base in Turkey, it can be both a positive and a negative, in the sense that people are going to look at that, and if they're not very sophisticated about what Turkey is, or very sophisticated about this ecosystem, they can think, I guess it works in Turkey, but what's the relevance? Like, could they really make it in the US market? Right, so it's almost like there is an extra step you have to overcome in terms of credibility to then expand into a new market. I was saying that I think Israel has done this very, very well. And, for a couple of reasons. One, I think the Israel, the economy in the market is smaller, and therefore they've always had an eye towards immediate sort of relevancy to international markets. They also, of course, have a lot of crossover between Israeli and US-based people and investments and institutions, and I think that creates a closer bond. And they also have that very deep technical expertise, engineering expertise, and the entrepreneurship drive that's amazing. But Turkey also has that. And I'm just wondering, for you guys as founders, how you deal with that, the positive and the negative of Turkey being a large enough economy and a vibrant enough landscape that you can really truly start here and gain traction to become a really viable company. But then as you go into, international markets, is that a positive or is that a drawback as you think about international expansion and international funding?
We have a question on YouTube. Do you think this funding madness in VC space will continue to grow in the future? If so, what would be the additional drivers creating more funding resources? Thank you.
So, do I think the funding craze and the growth of the dollars in the US are going to continue to grow? And then why?
What's the next?
I didn't hear the very first part of the question.
Sorry, okay. And if so, what would be the additional drivers creating more funding resources? What would be the additional drivers creating more
Money.
resources?
It's a flywheel in a sense, right? Early tech investments, early tech entrepreneurs, right, successful, created a generation of wealth. And then they took that money and they either started their next startup, or they started a fund, or they started investing. And then that generated another, that created another generation of wealth. And so as tech creates value, it creates money that people want to invest back into tech. And truly that money almost has no place to go, no other place to go. And so I don't see it ending anytime soon. I think if anything, with each successful year of these mega valuations, mega exits, right, mega opportunities, it creates more and more money that's looking for a place to go. And this is not necessarily my expertise at all, but people are saying that about the stock markets as well, and I'm sure we'll have a huge correction. at some point, but it's about the wealth that's created and the fact that it doesn't have a lot of other places for the investment to go. So where will people take the money out of funding tech and put it into what? I think it's a question mark. I think there's only so much sort of wealth that you can consume, and the kind of wealth that's created here for some of these tech companies and entrepreneurs and workers is sort of almost beyond consumption, really. And I mean, so it's really fueling additional funding going into the space. So I don't see it sort of diminishing anytime soon.
Over there.
Thank you very much for a detailed overview of the US VC market. I have a couple of questions, and when you look into new investment, what is the most important financial metric to you? I mean, can it be like ARR, compound annual growth rate, or enterprise value over sales? And another thing is, right now, in the pre-IPO market, in Series A, Series B, C, there is a possibility of making a 5x or 4x's. And do you see it is going forward because of the ample amount of liquidity in the market? Do you see a multiple compression in the market? I mean, 5 years from now, are we going to be seeing, let's say that an investor gets in Series A, and then at the IPO, after the lockup period of 6 months, he or she only realizes a return of 2x?
So your last question first, and then we can get into a discussion on metrics. I don't see that. I see it going the other way. I see it's almost incredible. We've been talking about one specific investment with another investor. This company that's been approached by a strategic for acquisition, and we're talking valuation. And the early investor, that's an institutional investor, not an individual, but a VC fund, they've said, it's not interesting to us unless it's 5x. So we're going to veto anything that's not 5x because it might as well be 0 if it's 3x. Right? So I think people's expectations are going higher and higher and not lower and lower. And so I see almost increased pressure and sort of decreased paths to exit as investors are requiring higher returns. And we can get into an interesting discussion. I'm seeing what we call a lot of structure in the LOIs, in the term sheets. So investors that are coming in will put veto rights and preferential liquidity that will have limits like it has to be at least 3x, or else no one, we will veto the sale. That we have the veto rights to veto a sale that's anything below 3x, and I see those actually creeping up. In terms of what metrics are really valuable, when I look at when looking at a company as a funder, I think it very much depends on the sector that you're in, right? But right now, I would say overwhelmingly the market values growth over anything else. So growth is king. I mean, we were laughing with Abu earlier that it's and profitability is like the kiss of death. I mean, if you're making money, that's just I don't even know if you know what you're doing in business, because certainly why would any company try to make money? And I say this as a joke, but I think that that's the initial reaction. When we look at concepts that are breaking even, it's like, they just got to be doing something wrong. It's so early. How could they possibly break even? So I think growth is king, and now growth of what? Is it ARR? Is it users? Right? Is it new logos? That I think can be debated in terms of whatever the concept is. There's a relevant growth metric there that people are looking at. I don't love combination metrics like the rule of 40. This has been a gold standard that everybody will talk about. Are you in the rule, above the rule of 40? I find that kind of irrelevant in the sense that, if you've got negative growth and high margin business, I mean, that's great business for you to own, but that's not a really investable business. And if you've got, whatever growth, but you're burning cash like crazy. It's just those two things. I need to know what the components are, and I need to understand how things are growing and what each of the trends are and where I think you're going to be in 3 years from now. So we tend to shy away from metrics that are compounding multiple variables to give you the one answer about whether a company is great or not. But I will say growth sort of over everything else is dominating the conversation right now in funding. I would say the other metrics that I personally really like to look at are sales metrics, because I come from the sales side, and to me revenue is king, and it's where growth happens. And so if we look at your sales and marketing model, and we really look at your customer acquisition costs and your sort of what we call the golden ratio about whether your investments in sales and marketing over the previous quarter have generated adequate sales, I mean, I see that as sort of leading indicators of what your growth is going to be in the future. So I tend to dig much more into the sales metrics and the health of your pipeline and how much cost you have to invest to pick up in customers and to drive growth. I know that other people that are more sort of financial comps oriented will also really look at unit economics. So I think that's also valuable because it points to future viability of the business. But for me, I think, you know, the growth and sales side tends to win over for me personally.
Thank you.
Any other questions?
Do you have any questions for us?
Yeah, I would love to know, I mean, I got some really interesting insights, I think, from all my conversations this week about the state of the Turkish funding market, and I have spoken to a lot of really exciting entrepreneurs. I guess, what are things that you would wish that you know, were imported into Turkey, right? Like if you could have elements of the US market be present here in Turkey from a funding environment or an entrepreneurship environment, what would those be in terms of supporting more entrepreneurship in Turkey?
Money.
Yeah, money.
Besides money.
Besides money.
What would you wish?
Maybe more companies are being eager to try solutions, because I know in US they are much more eager, like big companies. We have big customers, I have shown you big logos, which
Yeah.
we're lucky, but we wish more of them were like that. And sometimes some big companies are trying to do something on their own instead of like buying a startup. We see that in US more often. I wish it was the case, but I mean our exit strategy probably, hopefully, it will be like by a US vendor. I think if that is the case, it would be just better for startups.
Yeah, that's interesting. I love that, because I think, you know, give it a couple of years until those large companies see how much money they wasted and how little results they've gotten in terms of innovation, and then they'll start buying startups.
Yeah, it sometimes happens. And sometimes they just buy the like big vendors, like international vendors, and then they don't even give us try to start up, and then they just turned off. They just turned off, and then okay, it didn't work, so they will make one more POC test, and then they will come on. But things come to time. But yeah, I think we passed that point. But for the newly fund startups, I think that will be really nice.
Anybody else?
I have a question. Can you share your thoughts about the valuation of the company after successfully done their IPO status? Because like, there is usually a decrease of valuation at the stock price after like 2 or 3 months.
Yes. So what we've seen in the SPAC market, and I think it's very much related to this high valuation trend that I've talked about, one of the reasons that the SPAC market has cooled a little bit is in a traditional IPO process, you'll typically see like a 30% or a 40% pop, right, from prior the IPO to post-IPO in terms of share price. And that makes it very attractive for institutional investors who can get into the pre-IPO round, because you see an immediate pop in your investment. So what's happened on the SPAC is that because the private valuations are so high, and I actually also think because founders are so focused on this metric that they think the higher the valuation, the bigger the success, people are taking, too high a valuation into the public market. And the public market is looking at that and saying, I don't think it's worth that. And by the way, even if it is, it's not really worth me investing in it right now as an institutional investor. I'll just let, 3 months go by. I'll see what other institutional investors think, and then I'll buy, right? And so you're seeing investors pull back from that, and that's sort of creating this trend of like depressing prices even more because people are cooling off of that investment. I think the way to correct for that is, I think even founders and CEOs are now starting to understand this trend, is that you have to take a hard look at valuation and really think about the institutional investors as a customer, right? We, meaning our SPAC target and our SPAC at Build Group, are going to market to approach these customers and say, we think we have a great deal. We would like to sell some shares of that to you. And it really just genuinely has to be a smart deal for people to say, yes, I'll support this. And then the stock price is supported through IPO and beyond. But I think sometimes people think about that negotiation as across the table rather than a collaborative approach to say, what's a great valuation that the market is going to really support? So I think that's why we're seeing a correction in terms of valuations, and the SPACs are losing ground instead of gaining ground post-IPO.
Over there.
Thanks for this fine presentation, first of all. So I'd like to ask some comparison about, you mentioned about Austin, so it's actually improved maybe in terms of the capital in recently. So when you think about Turkey, there's a role for capital because there's a great talent, a lot of startups are looking for investments and so on, but especially in early stage is getting much better. Thanks for the area and kind of other investors actually in Turkey. But so there's a role for capital, as I said. So how such an ecosystem in Turkey will evolve in the future to make sure that more startups are going to get enough capital so they to continue their growth. Okay, so also case I'm interested. So maybe have some kind of insights about that. Thank you.
Yeah, absolutely. So I think one favorable trend is the growth of money that's being invested in funds, because they're searching for places to go, right? And a lot of the big guys like the Sequoias and the Andreessens of the world have now set up funds that are specifically targeting other geographies, and they're looking for expansion all the time. So I think that is a very favorable trend for geographies like Turkey, where there's deep technical talent and a real great entrepreneurial spirit. So I think that's going to naturally happen in one way with the rise of, or the increase in funds and funds looking for investment opportunities. The other thing that we saw, there's a parallel to Austin, is in terms of human capital. So one of the reasons that Austin got to be such a hot market is that there is University of Texas and additional universities around the Austin landscape were producing some really great engineers, and people really loved Austin as a place to live. And so there was great sort of untapped human capital there, and then all of a sudden people started realizing that, and companies were not just being formed there natively by those people, but other companies started coming into this space to capture that talent pool, right? So right now we're seeing so much migration from California into Austin because they see it as a cheaper market that has a bigger available talent pool than there is in California. I think the other thing that Turkey needs to take advantage of is to really highlight and position that workforce, right? Because naturally people are just looking for places where they can get engineering talent. So that's another one. And then the third is, nothing succeeds like success, right? And so as the Turkish funding landscape and the entrepreneurship landscape starts to experience some very successful exits, it attracts more attention and more money. And what I was saying earlier, which is as it creates more wealth for those founders and for those workers, that wealth also then gets reinvested. And it's not just dollars, right? I mean, so much of like that next generation of high value startups were started by folks that left Google, that left Facebook, that left Twitter, and then they started to open up their own sort of startups and having the ecosystems of their own. And I think that can happen in Turkey as there are more successful startups, as there are more successful companies, and their alumni, if you will, go off and start the sort of entrepreneurship journey over again after that initial concept has been successful. So I think all the things that happen to Austin in terms of becoming a tech hub can happen in the Turkish landscape as well.
I think we'll let you go slowly, huh?
One more.
Go ahead.
You touched on the popularity of fintechs. We see fintechs as mostly as payment systems first and then building on other services. Do you see these as disruptive to traditional banking, especially in capital markets like Turkey and other emerging markets?
I do very much, and I think everybody sees them that way as well. I don't have a ton of expertise on the banking side of fintech disruption, but I think what's been really happening, especially companies in Austin that are like Q2 and Kasasa and things that are creating engines that kind of sit outside of traditional banks and are then fueling either some of the business of those banks and or stealing business away from those banks has become really interesting. And so not just, I don't see fintech as only adding modules into that landscape, but also very much disrupting traditional banking. Now, I'm not an expert on that ecosystem, but the obvious question I think is for each each country, how regulated is that space and how ripe is it for disruption? Because the regulation can very much get in the way of disruption of new startups. So I don't have the expertise on it, especially to speak about Turkey, but even in the US, I know that regulation has sort of protected some of the traditional banking business, but I think we're seeing some really interesting startups coming to challenge that. Okay. These questions are getting harder and harder. I need to stop. It's like
We're just warming up.
Regarding mega rounds, for example, I think it was 2 days ago, one of the German startups for fast grocery delivery startup corridors, they raised $1 billion of funding. I simply don't understand the logic of injecting that amount of money into a startup, like from the both perspective, as a startup and also the funders. Can you give some explanation what's the logic of investment?
I don't know if I can, but I think honestly part of it is coming back to these trends, right? There's a lot of money. People are looking for high valuations. People are looking for very big checks that will allow them to run very, very fast. And once a mega round like that happens, again, winners are established in that space. So as a funder, if I know that this German company just raised 100 million war chest, on $1 billion valuation, and they're burning money like crazy, I don't know that I want to fund another company in that space to compete with those guys that's only raising a $5 million or a $10 million round. So, I think it can be, good and bad for those companies. I'm not sure if it's good for the landscape because it establishes winners maybe too early in a way that's not really warranted. And I, wonder whether people are using that kind of $100 million in a way that's really driving growth for the company, because there's only so much cash you can burn in a productive way before systems start to break and you have to fix them, so you have to grow a little bit slower. So I'm not really sure that I would be a funder that would be excited about writing like $100 million check into that kind of an early stage company that's raising money at those valuations. But as you can see from the market, I may be like one of the few people that are thinking that. It's gotten very competitive. So if you want to get into great, like very hot deals, I think those are the conditions that you have to meet.
One personal question. Okay, one personal question.
One personal question.
Yeah.
Okay.
Because we sit in a place where we ask people to come and invest with us, both as a funder and then in my position. And I don't know if you're familiar with the book Madness of the Crowds and Popular Delusion. So it explains all these hysteric
Oh, so
investment
good.
periods
No, I
and
need to read that.
I think after you read it, then it's kind of, you become more paranoid. Am I, when things are going too well, like today, well, if it ends in my time, so it becomes like a musical chair.
Yes.
So, aren't you afraid of that will happen in your time?
Yes, but this is why I'm saying, what's the alternative? So for funds that are not making any investments.
But what I see, for example, from software and tech, so everybody's talking tech. But for example, biology is going to be the new software for the next.
That's right.
So could that be another alternative to the tech sector?
I mean, I don't know if it can be an alternative, I think it can be an addition.
Addition, yes.
Yeah, I think that's for sure right. And I mean, people are starting to look at those, concentric circles of expansion, right? So, it used to be like, people used to say it's not rocket science. Now it is rocket science, right? There are a lot of VCs that are targeting space exploration, colonization, putting fueling stations in space. I mean, this is one concept that we saw from a SPAC perspective. Right? I mean, it's getting sort of further and further out. So I don't think necessarily people are saying it can only be software. We're just going to go all the way until it's software to,
Yeah.
But I don't see the end, like an early end to innovation and investments in entrepreneurship. But yes, different growing focus areas.
Thank you. Well, she has dinner reservations.
Well, thank you so much, Zeynep, for your time today. Since early today, it's been a pleasure. Hopefully you had a great time here.
I had a great time. Thank you so much for sharing all your concepts and all your hard work, and wishing you guys like much success as both founders and funders. Thank you.
Thank you.
Zeynep is becoming an ARIA member too.
Yes, of course I am.
Yes.
How have I not become an ARIA member all this time?
Do you have an Austin chapter?
Well, we have an international chapter, so you can become a member from wherever you are in the world.
That's right. So fun.
Thank you, Zeynep.
Thank you very much.